All right, hello again, everybody. This is Mike Rixey. I am the lead options instructor for NetPicks. And in this video, I want to walk you through why I feel the ETFs or the exchange traded funds should be a part of everybody's watch list. I get it. We all get sucked into the news cycle and we see the same markets in the headlines on a regular basis. Tesla, Microsoft, Apple, Nvidia, Adobe, any stock that has any exposure to the tech sector, anything AI related is all the craze right now. And you feel like if you're not trading those markets, you're missing out on an incredible opportunity. Well, I'm hearing two main issues from retail traders right now. First and foremost, the lack of capital. If you take a look at an Nvidia or an Adobe, if I go over to my trade page here, if we just take a look at the January monthly options, they have 43 days left on Nvidia or Adobe, and you just take a look at some options on the call side and the put side that are trading right around the at-the-money strike, you're talking about potentially over $2,000 per contract to put a position on. Very, very expensive, right? Nvidia is a $460 stock. Adobe, $600 stock. Now you're talking about potentially over $3,000 per contract. Well, what I'm seeing a lot of retail traders do right now is they might force the trade and end up risking far more of their account than they should, and they're not using proper risk management. That leaves them exposed to large losses. Or they end up going to the very inexpensive out-of-the-money options in the weekly cycles because that's what they feel like they can afford. When in reality, those options are cheap for a reason. They have a very low probability of success. What I want to present to you here today is how you can utilize the ETFs to get in for far less cost. Right? So it addresses the monetary issue there. And then the second main issue that I'm hearing from people is just the lack of time to go in and research. I get it. You're all busy, right? You're working. You've got holiday parties this time of year. Everybody is stretched thin as far as time goes, right? So the benefit of the ETFs is you can get instant diversification. You don't have to sit there and research dozens of markets. I'm going to show you a couple of ETFs that you can get instant exposure to many areas of the tech sector. So let's jump in and let's take a look at this in more detail. If I pull up ETF.com, I love this site because what you can do up at the top in this search box up at the top, you can type in the symbol of any ETF. What I've done here is I've typed in XLK. This is the technology ETF. And if I click on the holdings tab here, if I scroll down, it'll show us what individual stocks make up that ETF or that exchange traded fund. So what we're doing here, this is a $185 ETF. I'm trading one individual market, but I'm getting exposure to many individual stocks inside of that fund. If I scroll down and take a look at the top 10 holdings inside of XLK, you'll see them. Microsoft, Apple, Broadcom, Nvidia, Adobe, a lot of the big heavy hitters that we just got done talking about, right? The benefit here is if I jump back over to the trade page, instead of tying up $2,000, $3,000, $4,000 per contract on some of these individual stocks, if I take a look at XLK, now, whether it's the call side or the put side, now we're talking about between $350 and $500 per contract. Far less expensive. It's still giving me exposure to all of those individual stocks, but I'm doing so for far less cost. Not to mention, I don't need to take a look at the individual charts of Apple, Microsoft, Nvidia, Adobe. All I need to do is to pay attention to what XLK is doing. And that's going to give me exposure to some of those tech stocks, some of those AI stocks that are grabbing all the headlines right now. It's a great advantage to have these ETFs on your watch list. Now, why don't a lot of people trade these markets? Because they aren't Tesla, they aren't Microsoft, they aren't Apple. Everybody feels like they want to be involved in those highly volatile individual stocks, when in reality, you're going to tie up far less capital here. It's going to take far less time to track an ETF. All right. So if I jump over to a chart of XLK, we're actually looking at our reversal wave trader program. And this is on the hourly chart. The benefit here, and I'm not going to go into the details of what goes into these setups. That's not the topic for today's video. I'm just using this to show, okay, if I have either a bullish or a bearish trade setting up, there's things that I can do very, very quickly with the XLK options to come in and put on a position in either direction. I don't care long-term if the market moves up or down. I personally believe going into next year, we are going to have a lot of movement in both directions. I think volatility is going to return in a big way. You want to have exposure to both directions, right? So if I take a look at XLK, we're currently in a bullish position. The system is in a long call position. You can see my blue dots. These two blue dots identified my entry point. My target is up above. My stop is down below. The blue dots there, they all represent a bullish setup. All right, but now towards the end of the day, we have our magenta dots, and that's giving me a potential bearish setup going into tomorrow's session, potentially even into early next week. And if we get the market to roll over, I can react very quickly and come in and put on a long put position, which is a bearish trade. If I pull up my data box, the benefit of having a crystal clear system in place is if I put my crosshairs over those magenta dots in my data box, I can see that my entry point, my target, my stop, they're all outlined for me right here. 183.72 is my entry point. 187.51 is my stop. And my target's at 180.27. The benefit of that is I don't need to be glued to my screens all day long tomorrow or next week. I know exactly where my entry point is at, and when that level's hit, I'll come in and put on a position. So let's go ahead and take a look at what that position would entail. If we take a look with the entry at 183.72, let's jump back over to the trade page and see how I could structure the trade. I personally like to go out between 20 and 40 days with the options that I'm trading. That's where you're going to have the best liquidity. And when you're buying options, going out 20 to 40 days, we're able to limit the time decay. All right? Options lose value every day that you hold them. We're okay with that as long as you get the directional move in your favor. That's going to offset the time decay from adding up. But what can I do to limit that time decay as much as possible right off the bat? If I go out 20 to 40 days, yes, the options are going to tie up a little bit more capital, but I get a higher quality position and a position that's not going to be as exposed to that time decay right off the bat. If I take a look, and that 183.72 stock price, if it's hit tomorrow afternoon, for example, if I come in and if I put on the 184 strike put, at that point, it's going to be the at the money put. That strike price is going to be very close to the entry price on my chart. Right now, those options are trading for around $3.50, $350 per contract. They're going to be slightly more expensive once that entry point is hit here tomorrow, but it's still going to be less than $500 per contract. It's most likely going to be around $400 per contract. Well, if I'm tying up $400 per contract, it gives me control over 100 shares of XLK stock on the downside. I never have to trade the shares of stock if I don't want to. I can just trade the option back and forth. And that put option is going to increase in value as the stock moves lower. With this type of a trade, I am typically looking for a 3 to 12 day hold. I'm trying to predict what that ETF is going to do over the next 3 to 12 days. Not concerned with what's going to do 3 or 4 months from now. We'll cross that bridge when we get to it. We're just going to focus on what's going to happen in the very near term. So for $400, I'm coming in, I'm getting exposure to all of those individual tech stocks that we just talked about, right? Apple, Microsoft, Nvidia, Adobe. But I'm doing so for far less cost, and I'm doing so by trading one individual ETF. Okay, that's a pretty powerful approach. Now, the benefit is there are literally dozens of ETFs that you can trade. ETFs that track different sectors, different index markets, different areas of the world. You can get great diversification in a very short amount of time. Another one of the technology ETFs is symbol ARKK. This is the innovation ETF. And again, I just went to ETF.com. I typed in symbol ARKK in the symbol box up top. And if I scroll down inside of this ETF, I'm getting exposure to Coinbase, to Roku, to Tesla, to Zoom, Block Inc. So an additional list of some of those tech stocks, but I'm not trading them all individually. I don't have to go through another dozen charts trying to pick and choose what tech stock I want to trade. I'm looking at one individual ETF, and now I'm getting exposure to a whole additional cluster of those tech stocks. All right, very, very powerful approach. What about the financial names? Right, here's XLF. This is the financial sector ETF. I love this one here because it's a $36 ETF. If I go through and take a look at some of the individual holdings here, Berkshire Hathaway, JP Morgan, Visa, MasterCard, some of the big heavy hitters in the financial sector. Well, if I take a look, if I go over to my trade page, and let's go take a look at JP Morgan. It's a $156 individual stock, right? The options, they can get pricey. Nothing extreme, but they can get pricey. If I take a look at Visa, $255 stock, the options can get pricey, right? You can take a look at the prices of the options here. If I take a look at MasterCard, $413 stock, we're talking about on a lot of these individual financial stocks, you're talking about between $400 and $1,000 per contract. They get pricey. Now compare that to XLF. Now you take a look at XLF and it's a $36 ETF. Now we're talking about putting up between $100 and $150 per contract. Look at that 35 call. Look at that 35 put. The 35 put, you're talking about $36 per contract. Much more reasonable for the retail trader, regardless of your account size. And the beauty here is, guys, if you've got a bigger account, if you've got a six-figure account, you can certainly trade all of these ETFs. They're very, very liquid. You just have to bump up your size. And take a look at the volume and open interest on these XLF options. On that 35 call, 55,000 contracts of open interest. That's a ton of liquidity. You can take these trades with 20, 30, 40 contracts. Does not matter your account size. You can certainly adjust your position size accordingly. We recommend keeping your risk between 2 and 5% of your account per trade. If you're trying to trade NVIDIA, Adobe with a $5,000 account, you're not going to be able to stick to those risk rules. You're going to be risking far too much of your account on one individual trade. By using the ETFs, now we're able to use some better risk rules. Still set yourself up for some really nice gains, some really nice consistent gains. You're just tying up far less of your capital. And you're also looking at, potentially just a small handful of ETFs versus dozens of individual stocks. So XLF, if I jump over to the trade page here, if I take a look, we're currently in a bearish setup on XLF. So let's just go ahead and take a look at this one. If I take a look at the entry point on this, the entry point, 35.95. And we've been hovering right in and around that level for the last 24 hours. Let's say we're still sitting there tomorrow. We come in and want to put a bearish position on. Let's go ahead and jump over to the trade page. If I stick with my January monthly options with 43 days left, if I try to go slightly in the money, if I go up to the 37 put, those options are trading for, $1.50, potentially even less, just depending on where markets open tomorrow. You're talking about $150 per contract or less. That's your max risk on the trade, and it gives you control over the downside. If the market sells off, even if it's only for a couple of days, those put options are going to increase in value. It's going to leave you with a really nice return. Again, looking at one individual financial ETF versus having to look at a dozen different individual financial stocks. Far less time, far less capital. It's a great scenario for us. All right. Now that's just a couple of different areas. If you wanted to take a look at energy, you can take a look at XLE. You can take a look at USO. Those are two different energy ETFs. You can take a look at the index ETFs, SPY, QQQ, IWM. There's a lot of different ways that you can go. And I highly recommend it. Circle back tomorrow because we are going to take a look at our exact ETF watch list. And I will share with you guys, there's literally hundreds of different markets you can look at, but I'm going to share with you the best ETFs that we like to look at, ETFs that are going to give you exposure to so many different areas of this market. It's going to better set you up for long-term success. So make sure you check back here tomorrow. I will share that list with you, and then we'll take a look at some additional trades that are setting up for us and see if we can get some trades on here over the next couple of days. So if you have any questions at all, feel free to post a comment here on the video. You can always email me directly as well. Mike@netpicks.com is my email address. Hopefully you found that video beneficial. If you've not taken a look at the ETFs, if they're not a part of your trading, highly recommend you get them added here as quickly as possible. So I'm going to wrap this video up here. I'll be back with you guys here tomorrow, and we'll jump back in and take a look at the exact ETF watch list that we use on a regular basis.